traders, welcome to Charts and Coffee. Hope everyone's having a great morning. Ready to caffeinate and dominate as we start a couple major things happening today as we embark on this trading day. It is end of month, which while not nearly as volatile and tricky to trade as end of quarter, it's up there, right? Anything that signifies the end of something where decisions have to be made about whether or not to keep a position, to close it, etc. I mean, this happens every day, which is why the last, say, 20 minutes of the trading day are so volatile. This happens every week. Do we not, or do we want to take a position into the weekend? This happens every month. This happens every quarter. This happens every year. So this is just one of those events. Now, as if that is not enough, you add the FOMC to it as we're expecting a dovish pivot from Powell and Company, and this becomes a very, very tricky session because now we've got the end of the month as well as traders preparing for March or May. So we have to think about now, and then we have to think about, the next meeting or the meeting after that being where Powell will cut rates. But here's the thing. In terms of yields, the path of least resistance is lower, which is to say, if I'm taking a look at gold, which is on the screen right now, if I'm taking a look at bonds, the path of resistance is up. Path of least resistance is up. When we look at lower yields, that's going to send ZB, that's going to send TLT, that's going to generally send gold higher. And the more that picture of the cut is in focus, and it doesn't matter if it's March or May, as long as we can say, okay, we can expect it on this meeting, the more we're going to see equities rally. And by the way, if you're wondering, overall, forget the volatility of earnings and little pullbacks, nothing goes straight up, right? But overall, we cannot say this is not strength in equities. I mean, we're at all-time highs in so many places. So let's abandon this is just a new high to set up a bigger fall. I mean, let's stop that because that's been going on for 13 months for reasons I still cannot even begin to comprehend, and which tick me off to no end because it's kept people on the sidelines trading what they think and what they feel versus what they see, right? So that's what we've got here. Now, there are some challenges ahead. We have 5 of the 7 magnificents, maybe not so magnificents, reporting this week, and that's going to be a little bit of a drag on the NASDAQ mostly, but relatedly the S&P. There's 2 ways we can think about this, and if you have any questions, feel free to type them in. There's 2 ways we can look at this season, earnings season, which if you've been following Charts and Coffee, I hate this season. It's noise and it's nonsense that really doesn't have to be. Meaning, once upon a time, we got a little envelope in the mail that told us what the revenue and the earnings per share was. We got on with our happy life. We didn't have these nonsensical volatility events that disrupted what were trends, right? Much more organized price action without the spectacle of earnings. That aside, right? That aside, what we want to remember is high concentration weighting is going to make something like Google far more impactful to index traders in the NAS, in the S&P than maybe we want. So we've got to be really, really careful about what Google can do to 2 places, XLC and the NASDAQ, and then secondarily the S&P. But what about trading around earnings? The one thing that we are not doing in the Sector Secrets Mastery, and proof's in the pudding, gang. I'm not going to talk about what I think and random analysis. I'm going to tell you about what we're doing because, after all, that's why we're all here, right? To do. We're in things like GE. GE, don't you know magnificence of reporting? Don't care. In fact, want to drive all the way around that nonsense. Let's trade uptrends like GE that don't give a rip what Google's doing, right? We can trade beautiful uptrends like financials. Who out there thought financials was overbought and, it's time to short it? Please, please, please. Let's stick with the trend. Let's stick with the fact that we're in the bullish hemisphere. So we're trading things like Bank of America, JP Morgan, American Express, the strong non-tech part of the S&P, which is financials. So I hope everyone sees that there are ways to trade earnings. That would be the 642 approach to the ramp up, which you might say, well, Rog, did you do that? Yeah, in certain corners of the market, like Intel, where we had some decent trends in front of earnings, we bought calls on a dip and got out before the mosh pit. right? Or as I like to say, earnings are a lot like a high school party where everybody's having fun until someone calls the cops. We don't want to we don't want to be in there during the earnings release, right? So we'll go to the party while it's fun, and then we'll get out before the shenanigans begin. That's kind of the way I look at earnings, right? We'll look at the ramp up and then get out before that binary, up or down move. And it is just a coin flip, gang, just a coin flip. So I'm not going to reduce my income, my family's future, my trading account to a coin flip. Won't do that. There are better probability ways to look at this particular time of year. Probably the best way to do it is navigating around it when the release is coming, but taking advantage of that window 2 to 4 weeks out as we prepare for the volatility. All right. So speaking of preparing for volatility, what's on your mind? What do you got going on? And first up is looking at IWM versus XLF for February. So a couple things we don't do, right? And I know it's going to sound silly, but we have a couple 4-letter words. I know it's going to get PG-13 on y'all now. We got a couple 4-letter words in the Sector Secrets Mastery. Add. We never add to positions. What's an add? Let's be honest. I got in, but the market's not doing what I want it to do. So let me keep dollar cost averaging. Right. So that's one 4-letter word. The other one is think. I know, but wait a minute, Rog, isn't trading thinking? No, trading is seeing. What do we see? Automate the tools, right? They're unemotional, they're unbiased, they reflect the best version of our analysis and automate it, right? That's what your indicators should be. Your indicators should be the very best version of yourself on your chart without emotion, just telling you, Rog, before the money's involved, this is what you would see, right? Because money skews everything. So what do we see in IWM? Well, the best way to compare that would be KRE versus XLF. I would not compare IWM versus XLF. IWM I'd compare to maybe SPY, index versus index. But if I'm looking at the KRE and XLF, I like them both. I probably like the XLF a little bit better. But IWM, nothing wrong with what we're seeing in the Russell nor the regional banks. But I would say XLF and S&P are the better way to go. And so, yeah, a little bit of trade this, not that to kick off the morning. Thank you for the question. I appreciate that, Java. All right, next up is, love it. MTG says, what do you see in Goldman? And by the way, gang, this is not cutesy wording. Our words and our questions map to our actions and our thoughts. If you think that doesn't matter in trading, boy, you got to keep tuning into Charts and Coffee, because what we're going to do is prime you to ask the right kind of questions. And I only say that because I spent a good period of my young trading life asking the wrong kind of questions, thinking and feeling and hearing, right? Versus just trading what I see. So believe me, been there, done that. Don't want to do that anymore. So what do you see on Goldman? I like Goldman, but here's the question. Let's look at it another way. MTG, let's look at it through the prism of all the different stocks and financials. Is Goldman, and this is trade this, not that. So this is a little bit of what Java asked before. What is trade this, not that, gang? It's relative performance, right? So I know that you might have heard that phrase with the diet book, right? Eat this, not that. The reason I say trade this, not that is because relative performance is about what you trade is more important than how you trade it, right? That's the real reason for that. And so if I look at Goldman, it looks okay. It depends on how tied I want to be to the XLF. So that's why I'm in JP Morgan, MTG, but Goldman's fine. Goldman's fine. I wouldn't have a problem with that. Is it consolidating right now? Yeah, I agree with you in that regard. So why would I say that? Great comment. So let's go back to the charts here. All right. So I'm going to pull up Goldman and let's talk about the consolidation and how we can make this more objective, right? So let's automate the support and resistance. And that's exactly what these two lines do here. Now, when I've got that narrow little Darvis, there's a better chance that I'm going to have a momentum move to the upside, meaning when things are compressed at some point, like a coiled spring, it's got to expand. However, most traders want to buy as price is going higher through the resistance, which would be a 386.20 trigger. Let's look at it another way. If something is consolidating, whether you call that coiled spring, whether you want to use the Darvis, whether you want to call it a squeeze, whatever it is, it's consolidating. And expansion is usually the next thing we look at. So what I would prefer to do, rather than buying through resistance, I'd rather buy at support. They're both buys, but the positioning is superior. And I say that with two things in mind. One, I've got a better support level from which, if I'm wrong, I'm going to know much quicker, right? And two, I'm able to buy the call less expensively than if I bought with the bullish momentum. So, for example, on the 11th, on the 17th, on the 18th, on the low of the 19th, most recently, probably the 29th, as we're trading down into that Darvis support level, buy the call then, as opposed to moving higher, paying up, and then having to sit through the chasm of that zone, waiting for the eventual momentum. You're going to have a better price point. You're going to have better staying power in that regard. Now, do I want to trade Goldman? Look, I'm breaking down Goldman because that's the question. But, proof's in the pudding. I'm not in Goldman, nor am I necessarily interested in it. What we are in is JP Morgan, Bank of America, and American Express. So there's some things that I'll break down to show you all what I'd prefer to do. But then there are those things that we're actually in. Those three charts that I showed you, those are all Sector Secrets mastery trades. They're not consolidating. They've just pulled back and they've launched higher. So it's a different kind of thinking behind how I want to build a long position, but I'd still focus on the support level if I'm going to do it. But Goldman Sachs has not been in an uptrend for as long as American Express, Bank of America, and JP Morgan have. And that's why they end up at the top of the list. And that's why those are our three positions in the mastery. All right. Thank you for the question, MTG. I appreciate it. All right. And by the way, gang, if you're wondering, okay, Rob, where do we get these trades you're talking about? I'm in the Sector Secrets Mastery Room every day from 9:20 to 11:30. And during that time, we've got three things going on, and you can, like a TV guide, tune in when you want. We, in the morning, are day trading. Lorna Bot will be scalping as well. So for those of you that want a short-term approach to the very first hour of the day, which I love, 9:20 to 10:35, we focus on day trading. Then we take a break because, well, more coffee has to be made, right? Then we come back and look at swings. These are the swings that we send out as alerts in the mastery. So every morning, depending on which you'd like, tune on in to either the day trading or the swing, or even what most members do is both. And this is where we're setting up these kinds of trades. This is where we're trading around tech. I have zero exposure to the nonsense of tech this week. We're trading around that. GE, Disney, what else do we have? Oh, gold. We're focusing on places that have good structure that aren't necessarily going to be upended by earnings. All right. So that's over at sectorsecrets.com, by the way. All right. Swing trader. That's what I'm asking about. February. Yeah. I think I broke that down. Java. Yeah. I would say if you like IWM, I would say trade this, not that, go with SPY. And if you're looking at IWM and the best part of it, which would be regional banks, I'd focus on XLF. So yeah, hope that helps. With the 3-day rule, what causes sell-offs, upside events after earnings reports such as Google? What causes sell-offs or upside events after Ren, it's the same thing that would create volatility in any situation. What we expect is different than what we got. That's it. What we expect, what was discounted, is different than what we got. And that's it. That's as simple as it is. When we are looking at reactions, if something is in line, that's buy the rumor, sell the news. If something's far worse than we expected, there's your reaction. If something's far better than what we expected, there's your reaction. That's always the reaction. It's never really the numbers. It's how different the numbers were to what was discounted before we had the data. All right, next up, it's HSY. Jonathan, HSY. It's below the 200. I'm not really going to be a bear here because it's not really in a downtrend any longer. This is kind of consolidating, if not chopping. There's nothing I have here. If you're bullish, I would get long closer to 180. If you're bearish, I would focus on shorts between, say, 200 and maybe the 200. All right. But I don't really like Hershey. It's not something that would end up. So in a game of trade this, not that, sure, I could analyze Hershey. I could break down levels that might be useful. It's arguably overbought right now. I'd be far more likely to short sell it because it's in the bearish hemisphere. But then I think the question has to come before the question. And I'm sure you have your own reasons for looking at Hershey. But aside from that, the broader thing is, of all the things that I could look at, long or short, is this the best example of bearish index sector stock or bearish sector stock or just bearish stock? And I think that process is definitely something that when we step back and think about what we trade is more important than how we trade it, I don't know that the Hershey name would end up on my watch list. Now, clearly it's on yours for whatever reason. I would say stick to the short side. All right. Next up is, let's see here. Let's see. XLC, Jan asks, when can we get in? XLC is tough to trade because sometimes the option chain is really illiquid. But if there's liquidity, I would buy in the daily price movement range. That DPMR, that changes every day, though. Remember, so whatever DPMR zone I have today, this is designed to have the most accurate zones based on historical volatility for the session as possible. So each DPMR has a shelf life of today. And so right now I would buy in the gray zone, waiting for an opportunity to buy calls into weakness. That is my jam. All right. iPod Touch asks, how are you going to know when it's no longer bullish and not just volatility? My indicators, iPod. My indicators are going to tell me exactly when I no longer should be bullish. My indicators are going to tell me when we go chop. I'm always going to keep in mind, respect the trend that was. So it's going to take a lot for me to be bearish. And by the way, anyone out there who has for any length of time committed to the bearish side for the last easily 14 months has been categorically wrong. So let's be very cautious about not switching to bearish too soon. A lot of folks were bearish. I'm thinking of quite a lot of analysis that was bearish and pointed to really bad takes on macro, like inverted yield curves. Remember, it takes a lot for, especially with a dovish pivot, it takes a lot for something to go bearish. It's going to be really, in this environment, we can go chop, but I would still be bullish in the chop. So rather than buying dips in an uptrend, we can look for oversold buys, right? And I'm not telling you what I think. I'm telling you what has been. So be very careful listening to bearish analysis. Most of the time, bearish analysis, wherever you find it, is clickbait. It is clickbait, and it's been categorically wrong. All right. And so nowhere near am I to a bearish switch, my friend. Now, it's different if we're day trading or shorter term time frame, but if we're looking at daily time frames, which are the most psychologically significant ones, yeah, I'm going to stay with the bullish side. All right. Next up, when I say I have JP Morgan, Bank of America, et cetera, do I mean that I'm holding them longer term? These are swing trades. These are long calls, swing trades. What do you see in CMCSA? I love it. I love it, Michelle. Thank you for the question. What do I see? I don't see something that I love. Now, let's step back, right? If I'm looking at Comcast, what am I really looking at? I'm looking at XLC. So of all the things I could look at, is Comcast a decent uptrend? It's not bad. It's not bad. Meta, we know what's happening with Google right now. Netflix looks pretty good. So yeah, I don't have a problem with it. Disney, we're long Disney. So what do I see? In terms of a bullish swing trade in the 1 to 2 week range, here's what I'll say. If it sets up on the daily time frame, for me, it is usually going to be a 2 to 10 day window. But really, at the end of the day, all I'm doing is trading from my entry to the first target, to the second target, and then to expiration, right? So I'm going to have exits along the way. Now, when it comes to an actual setup here, the question is, for me, whether it's going to be a 1 hour or a daily time frame, because a 1 hour is going to be a shorter time horizon while the daily will be longer. But I would have to say this, Michelle, of all the trends in the XLC, this is probably the one that I'm least interested in. It's been very choppy. Definitely would want to focus on the long side. I don't have a clear setup as of yet. I really don't have a clear setup here. And so this kind of boils down to what I trade is more important than how I trade it. I don't know this ends up in, say, the top 3, even top 5 of things that I would want to buy, but it is definitely a buy on the dip. All right, gang, just like that 20 minutes flew by. Thank you for the questions, gang. Great stuff. Remember, trade what we see, not what we think. Trust our indicators. What are our indicators? Our indicators are the best version of ourselves that automate the process that we want to follow, right? It takes the emotion out. The indicators that I use are the ones that I know have worked for me for decades, not something I figured out 6 weeks ago, right? We don't want it. That's not time tested enough. We need to have something that can travel through all the different seasons, all the different personalities of market behavior. And that's why I have the confidence that I have in what I use. So if any of this resonates, come check out what we're doing over at sectorsecrets.com. I'll see you tomorrow, same time, same station for charts and coffee. Thanks, gang. Thanks as always for your time. Caffeinate and dominate. End of month, FOMC today. Caution, gang. Maybe more conservative entries, maybe smaller position size. I'll see you tomorrow.